Okay, I can see the participant numbers rising. Thanks if you've just dialed in. Probably be one more minute before we get going. Okay, well, I think we're just about in a position to get going. So thank you very much if you've taken the time to dial into this webinar today. My name's Tom Hughes. I'm the Director of Underwriting at the IUA. I should probably tell you who the IUA are before we get started, just very briefly. We're the trade association for the company markets, those insurers and reinsurers active outside of Lloyd's and active in the London market. We have around 80 member insurers and reinsurers at the moment. Now, I'll be overseeing the event today, and that just means I need to outline a couple of pieces of housekeeping for you. So we will be able to share a recording of the presentation and the slides in a PDF pack post-event, so please do look out for those. Now, if you've got any questions, we'll pick those up at the end and you can submit them through the Q&A function. So just take a look. There is a Q&A and a chat function. Use the Q&A one, and those questions will filter through for us to have a look at the end. Now, hopefully the question on screen has already grabbed your attention, because it certainly grabbed mine. How mature is your underwriting? And it's a really important question, I know, for our members at the moment who are trying to gauge exactly where they are in the grand scheme of things, the broader picture of the market as things are moving so quickly. Of course, we can't have a conversation at the moment without talking about AI and in particular Gen AI tools and the impact that they're having on day-to-day underwriting. Now, we're also talking to our members about the growth of MGAs, of captives, the use of parametric insurance. So I think the idea of our session today is to get a little bit of an idea from our expert Will here on perhaps how we can go about evaluating where we are in that process. So I should introduce William Harnett now. Will's head of business strategy at Send and has very kindly agreed to join us for the session today. Thank you so much for that, Will. Really looking forward to hearing from you. And I think with that, I'll hand over to you. I'll turn my camera off and let you take it away.
Tom, thanks a lot for that intro, and thanks for the opportunity to kind of run through these slides. Obviously, maturity and underwriting is a hot topic and all. So hopefully this will be a beneficial session to everyone dialed in. You mentioned kind of Gen AI. Actually, I'm going to back up a little bit and maybe start off a little bit less about the technology, more about operating model and how you approach your estate in a way and get ready for this kind of digital revolution. But in terms of a little bit about myself, I was 20 years with Access Capital, working kind of both sides of the pond, London market, New York based, 10 years as well. I've been with Send now a year and a half. So the observations I'm going to run through here are kind of real world experience. I think building and deploying products in a digital environment, spent a good bit of time doing that, predominantly in the US market. From my experience with Access, I've worked across the entire value chain, almost back to front. Started out in finance, moved to ops, IT, underwriting, distribution, product. So essentially over the years, working through those aspects of the value chain. From a digital business perspective and some of the underwriting experience in kind of trading in a more of a data-driven operating environment. Unsurprisingly, where I started out with the SME side of things, looking at cyber products, looking at management liability products, where it was really kind of aspiring to that 80-20 flow, so 80% flow, 20% kicked out. But from there, moving into kind of the lower middle market space, where that kind of 80-20 gets flipped on its head a little bit, where you're looking at 20% flow and 80% referral underwriting, kind of manual underwriting review, to then ultimately the convergence of digital with analog trading, more your traditional middle market business, and how you move those businesses forward. So that's plays into some of the experience here a little bit. So in terms of underwriting maturity in an evolving market. Didn't realize that would be so tricky. But the first point there, the path to underwriting excellence, it's not one size fits all, and I'll cover a little bit about that. And I think you'll see quite a bit of emphasis on kind of underwriting strategy and what's important for your company, your business unit, your underwriting team. I think it's kind of drilling down to kind of what's relevant for you, and who you are obviously depends on the role you play in the company. It's not all about the tech. I work for Send. We'll talk a little bit about Send, but not a lot. I think getting a lot of this stuff kind of figured out at the front isn't jumping into the technology, and possibly you'll have heard that before in other transformations that you've done. In terms of process to data driven underwriting, there's some logical steps we'll take through that. Different stages of the evolution. That's different stages by product line, or different stages in terms of the company that you work for. Talk a little bit about the underwriting strategy, and then finish up with a touch on the underwriting cycle. On the right, we've got a QR code that has our underwriting maturity quiz. So it's something that I'll pop up at the end in terms of, if you want to have a look at that, do it offline. But I'll talk to that in a little bit more detail as we go through the slides. For me, I guess it starts with the underwriting strategy, not the tech. And I think what I did here is I just tried to kind of copy down some of those key components of an underwriting strategy. And this could sit as I say, at a CUO level, or it could sit at a line of business level, or an underwriting team level. What are the major objectives for you as a business unit, you as an underwriting team? And while there's overlap across these things, there's different points of emphasis. Growth and distribution, there's specific things that you'll want to call out in terms of metrics and means of measurement and data points that will drive these components. And classically, where do we want to get with all of this? We want it all now. And I think the challenge is you can't do it all at the same time. So it's how do you prioritize and focus around what's important for you. In terms of moving from a process to data-centric world, this may not be the most exciting kind of component, and people won't be surprised that to go from the left to the right, there'll be building blocks involved. I call out the key components of process standardization, process measurement, efficiency, audit, and compliance. These are the age-old things that if you have multiple lines of business doing things in a multiple different way, if you don't have means of measurement in your process where you're looking at kind of quotes through the platform, looking at underwriting metrics, looking at kind of conversion metrics, looking at timestamps and things like that, these all play into where you want to get ultimately when you move to the right in that data-centric kind of world. Can you accelerate some of these things? Do you have to do that traditional as is to be and spend all that time on the process work? You can accelerate it. You can accelerate it through leveraging platforms, such as Send, where you can kind of leverage the vendor and the platform to drive that process standardization. And with those platforms, you will get the means to measure and the efficiencies and critically the audit and compliance components. But as you'll see, the common, like brilliant basics form the foundations for moving forward. I mean, it's not the exciting component. Tom, you introed with, Gen AI and all that kind of stuff. I guess I'm not going to say that these capabilities don't have massive benefit. They clearly do have benefit and upside opportunity. But there's some basics that you need to get. And one of the kind of the not so sexy things that, people don't really want to talk about is things like data quality. I mean, you will have heard, garbage in, garbage out. But as we look at moving from that process to data centric, documenting those underwriting data elements, such as the risk characteristics of what good looks like. Um, these may not be rating factor data elements, or they could be rating factor data elements, but really understanding what are those data elements that are important for you as a D&O underwriter, or as you as a property underwriter, et cetera, et cetera. For too long, I guess these data elements have lived in email and Word and Excel, and they don't get a chance to get into kind of an enterprise platform. If they don't get into an enterprise platform, it's very hard to harvest those data elements and drive insights and essentially a foundation for you to kind of build more data into it. Even though, like, from a data inventory, rules inventory, data quality, it's not kind of jumping out kind of Gen AI sort of stuff. I'll give you an example of a tier one carrier in the US in the middle market space. So they are today pulling down, for a management liability package, 100 data elements at submission, that they are using those 100 data elements as part of their underwriting process. So that already is a significant amount of data elements. But in addition to the 100, they're pulling down a further 200 data elements that they're tucking away to the side, that they know that they're going to come back around and look at that. So carriers are doing that today, because they understand what's important for them in the 100, but they also know that they're going to come back around. What I would say from a data inventory perspective is you can start small. You can start small of, like, what are the top dozen data elements that if I had them in a structured data format, how could that inform, my appetite triage process? Could I get to a quick decline? Even though, say, quick decline does give benefits immediately, it also brings in kind of data points for the actuaries and whatever data teams to start looking at what's coming in from brokers, broker management, that side of things. So there's a huge amount to start. There's a huge uplift in starting small in that data inventory. From a rules inventory, documenting. So I mentioned appetite there, but there's many times I've gone around underwriting teams that, when you say, can you show me your underwriting rules? Well, we have our, the underwriting kind of the approved underwriting guidelines that sit on the shelf, but like from an underwriting rule that kind of determines, if it's this type of risk in this, not just geo, but sub geo, or not just class, but kind of subclass. Like, what are those kind of rules that you'd say, we like that, we don't like that, or we prefer that over the other? And actually starting to write those rules down is super important. Um, Back to the kind of the opening bullet point, it's not all about the tech. There's an awful lot you can do in terms of defining the dozen data elements up front that are really important to you from a D&O underwriter perspective, the underwriting rules that make sense for you when a submission comes in, and actually asking an underwriting assistant or as an underwriter, trying to test those rules. Well, actually, my rule says I would or would not, or I would have prioritized that over another. Because the challenge is everyone wants to jump into the technology super fast, but it's a lot harder to change a rule. Once you're in a kind of a system environment. Now, don't get me wrong. Are there runtime rule capabilities? Is there advanced capabilities in terms of how you make change and push them to a production system? Absolutely. But the point stands just in terms of really understanding what makes sense to you from an underwriting perspective. And the same goes for data quality. You can absolutely hand, those dozen lists over to an operations team or an underwriting assistance team or a triaging team and say, for these 12 elements, here's some, guidelines in terms of, can we really make sure that data quality is spot on? It's a bit motherhood and apple pie, as they say in the States, but it's really fundamental from moving to this next phase of operating, where finally we're kind of going from, back to middle office kind of capabilities to actually moving into the front office and bringing kind of that value to the underwriters. I mean, we've heard it a few times just in our own world and in my previous world, like, what are those underwriting delighters? What is making it easier for an underwriter to do his or her job? So I mean, in buzzword bingo, I'm, however many minutes into the meeting, and I'll say AI agents and agentic processing are fantastic when you're looking at this stage of processing. Those underwriting companies that, have got this figured out really do have a good handle on their process and the measurement of what are those widgets going through the factory floor. They also really understand those pertinent data elements that inform, what you want to do with that risk and how you want to do it through those rules. And critically, they've spent the time to kind of say these 12 data elements are really important. How do we kind of get some good DQ or data quality around those, leveraging a BPO team, operations team, or even a UA doing a pre-scan to say, that any ICS code it looks about right, or that address looks off, or when we look at revenue, making sure that revenue is the right revenue. When we look at years in business, that really that data point is important. Say for years in business, you could determine that you don't want to look at companies that are less than 3 years old, or for whatever reason. So understanding that DQ piece really kind of moves you into that next level. Um, it's a fact in a way that the more you see, the more you'll want. So the more you get into a structured data operating state, the more you'll say, okay, now I understand more about that risk at a data level. How can I now get kind of slightly deeper or more data elements available to me? And this is where you start going out into the augmentation phase, where you start going out to third-party data services, bringing in more data into it, and assimilating that data in with the broker data to help improve that risk selection process. In terms of underwriting productivity, I mean, a major driver of underwriter or even quote conversion is this quote turnaround time. And it may not be for the most complex of risks, but for a middle market, kind of 80% or 70% of the books of business that we see, um, that classic, the quote that gets back in a more efficient, timely manner has a higher probability of conversion. So when you start getting into that measurement and understanding what processes you can improve to bring down that quote turnaround time, suddenly you're hitting pretty good numbers from a productivity perspective. Price adequacy, portfolio insights, I can touch them in due course. But what we're trying to kind of display here is there is a set approach to how you may want to take and drive through this process. Everyone does want to jump into that third column, and can you do it for niche examples? Can you pull up an AI agent service, and for risk summarization or a kind of even a risk scoring is kind of difficult if you haven't defined those underwriting rules and what does good look like. So there's just a bit of housekeeping that needs to be done to optimize some of these capabilities going forward. So to kind of the different stages of the evolution, I'll do like a very, very brief kind of overview of how we segment this up a little bit. Manual kind of speaks for itself a little bit. Digital, this is where we're leveraging more structured process and standards and measurement. So that's getting us into operating in a kind of a base workflow operating state where we can at least look at more that ticket or that widget that it goes through the process, and we can kind of get better measurement and start surfacing some of that structured data. Connected, here, when I mentioned in terms of pulling in kind of third-party data services, so we're operating now, moving from a kind of a process workflow enablement to start kind of that start of a data operating kind of world, where we're taking the second party or broker data into our system in a structured data format. We're augmenting with external third-party data services, and we're surfacing that data in a reasonable user experience for the underwriter to kind of assimilate that information and opine on the risk. So it's really data harvesting, data augmentation for that risk, broker data, third-party data services. Third, augmented underwriting. So this is, I mean, the kind of the catchy phrase on this one is where you're looking at turning the data that you've harvested in that connected phase, but turning that data into insights. So it's taking the data and overlaying that data with contextual information around what it means for you as a carrier, what it means, that risk relative to underwriting strategy and underwriting criteria. So suddenly now it gives the underwriter an opportunity to take those insights and apply their knowledge to those insights. So we're really getting into that value add set of processes for the underwriter. When we get into the smart underwriting world, that's really that dynamic underwriting space where you're monitoring risk exposures and processes and pricing more on a continual basis, where you're updating prices to reflect changes. That's not, I mean, the obvious point here is this isn't for every line of business. You know, one size doesn't fit all. It depends on the risk characteristics that you're looking at, and what makes sense for your line of business at the stage of the journey that you're in. Um, there's different ceilings for different lines of business. So as I said, not one size fits all, but if you look at, say, a bespoke underwriting kind of set of products, or you look at products that have on the higher spectrum of complexity, the ceiling that you may want to kind of strive for is maybe a connected underwriting space, or in a kind of a middle market modern complexity into that kind of start of that augmented underwriting space, where absolutely you could start leveraging and gaining insights. For that high complexity space, there's absolutely aspects of augmented underwriting that you could bring in. So, I mean, it'd be silly for me to sit here and say, like, for that offshore oil rig, like, you know, you can absolutely process that through, and you're getting very tight on SLAs, you know, for a heavily complex submission that has multiple kind of major coverages associated with it. But for each of those major coverages, you can do an awful lot in terms of bringing in the right data, summarizing that data, augmenting that data, presenting that data to the underwriter for them to opine on that. And as you go through unsurprising, as you go through that kind of come down the complexity tower into that kind of lower complexity SME space, that's where you're looking more to get into that augmented underwriting. And then ultimately, you know, if you want to be in that portfolio driven underwriting or algo lead space, is where you'd be leaning more into the smart underwriting strategy. For here, to make underwriting successful, you need to solve the end-to-end risk journey. So the way I kind of think about this is, what we're trying to do here is less an underwriting transformation, and it's more of a risk transformation, that you really have to work across the end-to-end flow. I mean, if you don't get your submission and clearance figured out, or the data at the front door right, there's very little you can do in terms of automating your appetite triage, or driving those deeper risk and exposure data elements into your risk prioritization and risk assessment process. So I guess what I found in my experience doing this is trying to drive more digital processing into the underwriting journey. There's nothing new about cross-functional teams working together, but it is of critical importance that these cross-functional teams almost start on the journey together, that you're really hand in glove across, you know, underwriting operations, data teams, app dev teams, that what are those data elements? What are the data quality processes? What are those underwriting rules? How do I feed that into the workflow and the underwriting process? So I guess, I mean, it's a major point to emphasize that, getting the collaboration across, whereas historically it would be, over the wall as part of the process. But if you want to successfully move forward in this digital operating state, no longer is it like, each of these functions operating in silos. To now talk, I guess, a little bit about, where you are today and where you want to get to. And I think the business strategy, I think, really helps to kind of identify those critical areas you want to focus on. If you think back to that second slide, we've got growth and distribution and expense and rate adequacy. these are all really important aspects of where you want to bring your underwriting book and your profitability, etc. But as you kind of start out, it's very good to kind of focus in on those areas that are of priority. So for this example, we're going to say, okay, so rate adequacy and overall shape and performance of the portfolio is of critical importance. So we're kind of saying, okay, we're not so worried about, the automation in the process, but given, say market cycle, our number one priority is rate adequacy, and we really want to focus in on, the quality of the book of business to make sure the shape of it is where we want to get it to be. So fairly grand kind of strategic goals, and they wouldn't be a surprise, I don't think, to anyone on the call. So if we look at, um, you know, moving the as is, so this, I'll go back a step here. So if we look at, the as is, the QR code that I put up at the front there, at the first slide, and I'll have it again down the back end. That'll help you as a series of questions across each of the kind of the value stream steps of the process to kind of say, where are we at a submission and clearance stage? Where are we at appetite triage? And so on and so forth. And it kind of says, okay, that allows you to do that assessment of your as is. Now, where you want to go with that will be informed by those strategic priorities. So for this one, we said rate adequacy and portfolio optimization. So yes, as part of our strategy, we want to get access to greater risk and exposure data at the front end of the process. Yes, that'll help us to improve submission and clearance. It'll allow us to bring a level of automation into our appetite triage process, but which is perfect, which is exactly what's needed. Um, it will surface, data into our risk prioritization, risk assessment process. But if you can see in terms of the maturity level of those, we're not really doubling down. We're not saying we're going to be all singing and all dancing from an augmented underwriting kind of state at this stage, and that's okay. Um, there is FOMO, there is all this stuff going on, but really understanding what's important for you at this point in time, and these are all building blocks. If you get the structured data right at the front door, then coming back around and looking at quote conversion models or loss propensity models, or ways of driving more streamlined risk assessment by having dynamic user experience by line of business, these things will absolutely follow very quickly. But remember, we got to prioritize on what's important for us for this quarter or next quarter or whatever. So getting to a connected set of underwriting for this line of business is fine. But what you will see is we've moved the needle on from a price adequacy and a portfolio review. So how does that work? If we have a deeper set of underwriting data that previously was sitting in an unstructured state, as in unstructured being emails, Word doc, Excel, but now we've brought that data in a cleansed structured state into our enterprise systems, the actuarial teams can now start looking at loss trend analysis and looking at kind of loss drivers to kind of see, okay, are we kind of looking at it from a more of a fine grain pricing basis? Now, we may not get exotic yet with our raters and start bringing in, that more detailed granular data. It will in time, but it doesn't have to happen today. But it gives those pricing actuaries an opportunity to do that assessment of the price adequacy, looking at that more complete data set to drive data set around those loss drivers. Equally, from a portfolio insights, instead of operating at an NAICS and geo level, maybe we're bringing in subclass and sub jurisdictions and more of that underwriting data into that overall portfolio review, and critically, we're bringing that data in a more timely fashion. Historically, you would be looking at product performance reviews, a quarter in arrears, but suddenly that you've brought not only this data in a more streamlined, efficient manner, but you've got more detail on it, that suddenly you can start drilling down and look at those profitability metrics, at a more fine-grained basis in a more timely fashion. So it brings on, right? So they were our kind of key strategic priorities. We have a better handle on our pricing and our price adequacy. We're very comfortable with, our underwriting portfolio and the shape of it as per our underwriting kind of strategy and our guideline. you know, Tick, tick. Now you can start saying, okay, next is efficiency and maybe underwriting productivity. So I guess taking kind of all of those kind of points into mind, like, I come back to this strategy stuff. I mean, it can be perceived as this waffly, it doesn't really relate to me, when it comes to my underwriting team and what I'm trying to do around our objectives. I mean, classically, it's increase the premium by 10% or, manage retentions to an appropriate level, et cetera, et cetera. But having very specific kind of guidelines around each of these metrics and drivers and understanding what is priority will help you build that that risk transformation strategy and allow you to focus on, the first one or two things rather than just being all consumed by everything. Back to that, I guess, third slide. Everybody wants everything yesterday. So it's how do you kind of prioritize what's really important from a CEO perspective. So if we look at some of the growth drivers, if we say, prioritized risk from a growth perspective, prioritize risk, summarize exposure data, increase quote conversions and retentions. So what are the drivers there? It's structured data insights and automation. We look at distribution. How do we get more of it? You could say digital SLAs, etc. I mean, those broker surveys, when they come around, they are tiering their carriers. So being able to kind of prove through automation and that QTAT, that quote turnaround time, suddenly you'll start going up those broker tables. But what's important from that distribution perspective is understanding that data at the front door, maybe albeit to an appetite triage level of specificity, building out those integrations, albeit maybe it's a kind of a simple PPL white space or it's a peer-to-peer integration with a broker system just to land a submission, nothing exotic. But what that'll do is it will help drive that quote turnaround time, which is a key metric that the brokers kind of measure themselves on. Risk selection and quality of risks that you're selecting. So quality, speed, portfolio insights. So when we talk about, or I mentioned that tier one carrier, mid-market carrier in the US, they're pulling down 100 data elements. Suddenly, they're building a very, very clear picture around what good looks like from an underwriting perspective. Those third-party data, so that third PD is third-party data vendors and understanding I'm a cargo underwriter. How can I access and pull in that augmented data and land it in a structured format that'll help me underwrite that risk better? So if risk selection, not necessarily top line, but what comes in the door, making sure we get the right risk selection married up with rate adequacy, obviously, is important. Well, then let's focus in on those aspects of our risk transformation. Loss drivers, I touched on that. Structured data and insights to drive better view of exposure and I guess I kind of tend to say underwriting data and exposure data. Underwriting data are those data elements that may not make their way into the rater. They're not necessarily a rate mod factor data element, but they're the data elements that, back to those risk characteristics that you kind of say, actually understanding more about that risk helps me, make a decision on is that something I like, don't like, or how I would prioritize it over another. So understanding those kind of underwriting data elements and getting those data elements into a structured data format will absolutely help downstream. Expense, the obvious one there is underwriting automation. If there's opportunities to do things like smart delegation, bring operational cost out of the platform. And then finally, the area I have highlighted here was portfolio underwriting solutions. If you want to get good at this, digital trading with algo lead or follow, working with broker facilities. What's really important there is being good at integration, understanding the data that you have to harvest at the front, having those rules that you want to overlay, and being able to kind of get those insights to make sure that what you're writing is the right kind of business, and you're hitting the kind of the metrics that you want from an underwriting and profitability perspective. Okay, so what does this all mean? I guess I tried to kind of summarize it a little bit here in the underwriting cycle, to kind of take that not so waffly underwriting strategy and getting that clarity written down, understanding the data and the rules associated with what's needed to support that strategy as prioritized. This is the first time I've really mentioned, I guess, technology, and a solution like Send is, when you start moving from that process to that data-driven operating state, you're essentially going to need a data orchestration layer. So this is where you can manage that broker data, third-party data, internal data, loss data, or experience data, and you want to pull that into a view for the underwriter for them to see it, is where you got to start thinking about that digital orchestration layer. What happens then when you have that kind of that data operating environment is you start harvesting insights. What happens when you harvest insights? You expand the need to acquire more data, which drives into a more fine-grained portfolio insights, which will then inform, or where you want to go from an underwriting strategy perspective, may reprioritize what you're doing. So I guess that's the underwriting cycle, where you really want to take those portfolio insights and shift them into line of business underwriting. So if I look at that, top left is portfolio driven insights, and you want to loop that all the way down to your digital orchestration layer. If at a CUO level, you can look at the attachment points that you're coming in at, the class concentration that you're seeing, or a sub-geo concentration, and I'm not talking cat, I'm just talking about kind of non-cat sort of stuff. If you can then inform, what a line underwriter is doing by kind of tweaking those appetite triage rules, as more aligned to what you're seeing at that portfolio level, that gives you a very strong control over what's happening, throughout the process, and you can kind of see, where those changes are made at a portfolio level, and how they impact at a transactional account by account underwriting level, and do they feed back through around to have the desired effect. I guess to continue the buzzword bingo here a little bit, it's kind of when you're at the state of maturity around your data and rules and process and orchestration layer, this is where you really can have that opportunity to kind of take off when it comes to leveraging agents at every aspect of the process. Nearly, if you look at that submission intake, the ability to kind of do summarization, the ability to kind of take your underwriting rules and feed them into an underwriting co-pilot that'll help and support that risk scoring that you want to do, looking at loss propensity and driving that into some of the decisions. So having that kind of groundwork and that housekeeping done, understanding the data, and back to that kind of not so fun thing of data quality, and making sure that what you have in your estate is right, is really the opportunity to kind of move the needle from an underwriting kind of AI driven space, where in an augmented state of maturity, you're bringing that insight overlay onto the data, and purposefully there's a human on the left hand side with the bot. This is where the underwriter knowledge plays into it. I think we very much of the view that this isn't a replacement, this is an augmentation, and it's streamlining whatever the stat is. If it's a 40 or 50% administrative work that the underwriters are spending their time on, clean out that administrative time, bring in this overarching insights, and then suddenly the underwriter has more time from a risk selection, from a distribution relationship perspective. So getting this right, it will help in terms of potential inflection points in the market, like those that are focused on it and kind of adopt these capabilities. We'll see the opportunity grow probably at a faster rate. I'm working off 45, I think was my time slot. So with 3 minutes to go, and I've been speaking, I guess, for a long time. I'm an underwriter. What can I do next to drive this forward? I just wanted to drop in a slide a little bit to kind of say, okay, this is maybe overwhelming, or maybe I see the steps that I need to take. But um, as an underwriting individual, as an operations individual, as a underwriting assistant, or whatever role you play, you know, I guess not accepting the status quo and how things are done today, but specifically from an underwriting perspective, segment your portfolio, like understand the composition of the book. Back to that slide where I had kind of high, moderate, low complexity of risk. Um, you might find when you really drill down, and I guess I say this based on my experience of, underwriters are very much caught in the this risk, this risk, this risk, this risk, and kind of working through under pressure to get through all the various submissions they have to get through. But finding the time to go back, look, and really segment the portfolio or book of business that you have and say, well, actually, this might fall into the kind of the lower complexity side of things, middle kind of high complexity. Are there things we can do in terms of, or how could I have different strategies by those segment of risk type? Unsurprising, you'll hear me say identify the 10 to 12 key data elements. Sit down with your ops team, say these 10 to 12 data elements are non-negotiable. I need them early. I need them in a quality state. And from that, even without technology, I can drive an awful lot, but get that to a good state of understanding in terms of what those data elements, and bring the team, the operations team, and the data team with you will be super beneficial. The last one, the underwriting rules, I think I mentioned it earlier. You don't necessarily need the technology to start test and learn on whether or not, having an underwriting assistant in a manual state say, look, if I applied these rules, this would have been the behavior that would have occurred. So I think, if you're to go back to your desk and, over the next few days, really understanding, those important data elements, understanding those rules, and starting to look at the process. So Tom, I will stop there with a minute to go. Hopefully that made sense. Actually, what I will do is, sorry, I probably was ahead with my narrative to the slides, but anyway, I think everyone will get the slides. I think after the fact, and I just wanted to kind of leave that QR code up as well, which covers some of the covers the quiz, in fact.
Thanks very much. Will, certainly plenty of ground to cover there in 45 minutes. So a very good job in keeping to time. And I think it really gave a good flavor of what CUOs within our member companies and more broadly in the market should be thinking about at the moment. And I think that was the key aim of this session. One of the areas that I had in mind, and you did touch on it, but it's just from your experience working with different companies around these areas. Where do you think the market is at the moment? Perhaps on that nice slide 9 scale that you had there, across the sort of the core principles. What's your flavor for where we are?
Yeah, it's a good question. And I did this exercise a little bit based on my experience looking at the US market and comparing it to the London market a little bit. What I would say is the US market has probably I'd say is a little bit further ahead in terms of its comfort level in kind of leveraging and using data as part of the underlying business process. Where I'd say the London market is operating at, I'd say it's in that kind of digital underwriting kind of space, slowly getting into that connected space. We've seen all the market kind of papers on augmented and where we want to go, and I think there's a lot of fear of missing out, and gosh, am I at pace with my peers? There are a handful of tier one carriers who are operating in that augmented state. That's not tier one necessarily by size, but like by operational efficiency and how they're underwriting. But I'd say in the main, like we're in that kind of 1.5 sort of sort of state would be my take, Tom.
Yeah, I appreciate that, Will. It's that's very helpful to have. Just a point to note for those that have dialed in, this is a perfect time to place any questions that you do have into the Q&A, because otherwise you'll have the few that have cropped up into my mind during the discussion. But it would be really good to hear from you, whether it's a question or it's a comment, something for Will to consider. Will, the second question I had related to what you've just discussed is actually how different individual firms' underwriting operations are and the processes that they currently have in place. Because my sense is that often we talk to definitely some of the larger companies, and they've got plenty of legacy systems in there and challenges that have perhaps come out of mergers and
Yep.
acquisitions. So, how I suppose how easy is it to work some of these methodologies across so many different types of of entity and process that sits within those entities?
Yeah, and I think we're probably, so that's a historical challenge, like that's existed for some time, so carriers will have multiple AS400 systems just sitting out there through acquisitions or otherwise. Where we're at, I think in terms of the technology is there's a really good opportunity to kind of, as I mentioned earlier, there's ways and means to accelerate this journey. It's not like, oh no, we got to do all of this by adopting or partnering with vendors such as Send. I mean, you can accelerate that process standardization, but not only that, what it allows you to do, it allows you to insulate the key stakeholders from the legacy technology. So you can put those orchestration wrappers around the legacy tech, bring that kind of single pane of view experience for those underwriters, so that no longer are the key resources bouncing in and around multiple systems. Now that just maybe papers over the cracks of the challenges, but it gives the companies an opportunity to peel off strategy. So peel off whatever legacy systems that they no longer think are fit for purpose in a safe, controlled, and can manage those expenses or the cost of doing that manner. But critically, it's not slowing down that underwriting maturity and that underwriting evolution of where the underwriters want to go, and brings that data orchestration layer, that opportunity. So I think the timing is good. Age-old problem definitely exists everywhere, but the timing is good.
Yeah, thank you, Will. And a really helpful question that's just cropped up. If we could start again without legacy systems and data, what would be the core approaches? I think this is so interesting because this is a sort of question that actually we saw a number of international markets asking themselves probably, in over the last couple of decades, because they don't have some of those challenges that perhaps we do from a London market perspective.
Yeah,
So
I
where would we
think.
start, Will?
Yeah, I mean, uh, if you're starting out, I mean, you can go to more of that, data first state of operating. So you will have the technology, and well, I say the technology, but if you are jumping in 2 feet to drive it in more of a data first way of operating, you will have to still do the homework on what are those kind of data elements that are more important, but you don't have to deal with the legacy issues of, well, I have to do this because the system requires it to go downstream, et cetera, et cetera. But I think those carriers that have, largely you'll see, progressive MGAs, jumping straight first into, that data orchestration. And I think cargo and IoT is the kind of the perfect example, like to start taking, data driven data points into the underwriting process from day one. Um, in my experience, allows them to kind of price those risks at a better price point, not necessarily higher or lower, but at a rate adequacy that allows them price it better to the competition that will drive more business towards them for better risks. Um, the challenge that I found a couple of years ago was for those carriers that have legacy systems. I had the opportunity to build out from a fresh start, a digital underwriting environment. But then the challenge was convergence of digital with analog, and then trying to figure out and solving for the mothership, like, brings in problems. But I think if you can start afresh with a data first mentality, and that data first mentality is, how do I want to think about the underwriting? That's why I use the example of cargo and IoT. I want to
Mm.
think about the underwriting slightly different, and this is how I would do it. Like, or you're a fleet, how do I get access to fleet data and drive that fleet data in terms of size and make and condition of those fleets? How do I drive that into my underwriting process? And I guess what I didn't mention earlier is, this kind of desire to get to, digital processing and data driven, or data driven underwriting. There's just enough straight through processing, or there's just enough data augmentation. So whatever level of complexity that you have for your business, there's still a lot you can do in terms of surfacing that data, driving insights into the process, even if it becomes a manual process after that. I think having that kind of that data first mentality into your underwriting strategy and approach, I think will seriously help for those starting with a clean slate, so to speak.
Yeah, and a question related to that has cropped up, Will, and it's how else can data within the insurance sector be increased to match other sectors' standards rather than, sometimes we're perhaps a bit behind the curve or be behind in other industry standards.
I think you almost answered the question, answered it with the question in terms of, like, we're behind the curve in terms of standards. I think um, getting to a more expansive, getting to a set of data standards, and then being able to grow those data standards out to be more line of business relevant, I think will, if you just think about the efficiencies that can go from broker to carrier in more of a standardized structured data kind of format, can but help improve the process. I think the point I mentioned earlier about starting with your 10 to 12 data elements, once you have those 12 data elements in a structured data, and people are feeding back insights on those 12 data elements, there's an abundance. Like, we're at this kind of point where there's such an abundance of third-party data vendors who are supplying, really, really rich levels of information. The problem that underwriters have is, I've got too much info coming at me. How do I assimilate that into something that's meaningful? And I think that's where, if you're at that stage of evolution, that you can leverage some of these kind of AI agents to help with that assimilation process. But I think, getting the data standards for some of the front door submission stuff at a minimum, I think would move us along massively.
Yeah, agreed. And that talks to a question that's just cropped up. So they're coming through pretty quickly now, which is good. So how can you ensure data is efficient to all parties within the value chain, brokers, carriers, reinsurers? I'm not sure if the word efficient is the one we're looking for there, but I suppose a value to all of those parties. Is it that
Yeah,
consistency point you just mentioned?
yeah. Well, I mean, it's funny, like, talking to reinsurance companies, talking to insurance companies, talking to carriers operating in a delegated space. It's kind of all the same stuff. Like, delegated carriers in a delegated space want to get better access to the underlying risk, so that they can essentially, leverage kind of and overlay their underwriting rules and make sure that what's being done on a delegated basis is fit for purpose. Same from a reinsurance company. Classically, where has this data resided? The data has resided in a policy administration system. A policy administration system contains maybe 30 to 40% of, the structured data that is associated with that risk. It's that policy admin system that tends to push an output set of data at a contract level, like, it's this limit, this retention, inception, expiration, whatever, not necessarily the underlying risk data associated with that contract. And I think if you were to ask a reinsurance company, would they like to get better access to that underlying risk data, they'd bite your hand off, in the same way as a delegated carrier wants to get a better understanding of the underlying exposures and risks. So where I would say is, like, if you can, if the insurance company wants to get access and use that structured data better earlier in the process, making that data available to the other consumers of that data in the macro value chain, You mentioned parametric at the start of the process. That's fundamentally what that is. That is a objective, data-driven operating kind of platform. And that just is the pinnacle, I think, of leveraging data through the end-to-end macro value chain.
Yeah, and I'm getting the impression, Will, that checking in with you periodically as these various developments unfold, and they are unfolding pretty quickly at the moment, will be really valuable. And it's probably the last chance for me to just mention the QR code on screen. If you want to take the opportunity to take the maturity quiz, last chance now before we take the slides off screen and close the session. But thank you all for taking the opportunity to provide those questions. And I've got no doubt, Will, if people have questions post event, and perhaps if people are watching the recording of this session, and want to get in touch, are people okay to contact you directly?
Yeah, absolutely, absolutely. Yep.
Okay, no, that's fantastic. Will, would you like to say anything as by way of final wrap up before I just let everyone go?
I 45 minutes of me talking. I think this was a great opportunity for me to share some of the kind of learnings I've had, some of the things that we're seeing, and I think, as I said, the opportunity now is fantastic. FOMO, there's a lot going on, but I think there's a lot you can do starting today, tomorrow. So thanks for the opportunity, and as I said, happy to take any follow-on questions or queries that may come my way.